I'm going to start the recording now. Hopefully we don't have any hiccups. So, all right, let's go over here. We got 1, 2, 3, 4, 5, 6. J-Pone, how's it going, man?
Hey man, doing all right. How you doing?
I'm doing well, thank you. All right, so we got Crazy in here for now. I know he said he might not be able to make the call, so he may drop off, but we'll see. We got Proteus, Franklin, Brawl Star, Haverl. Is that how you say your name? Haverl Mink or Haverl? Sorry. And then I'm probably going to get going. So if there's anybody else that joins the call, they can play catch up since I'm recording it. So let me share my screen before I forget. Okay, so I'm sharing my screen. So I'm going to go over a strategy real quick that Crazy posted in the general chat. Where is it? Here. So this is the strategy that he posted. And it is very simple, so it's kind of nice. I'm going to go over it, but it can be tested back to 2011 since it has VIXY and VIXM in it. So those only go back to around October 2011. So the strategy does let me go down to the stats. So it's got an annualized return of about 71%, a max drawdown of 48%, a Sharpe ratio of 1.37, which is really high, especially on something that you can backtest more than 10 years, and a CalMAR of 1.46, which is also really high. So good stats. It uses leveraged ETFs, so it uses TQQQ and SPXL, which is a NASDAQ 100 3x leveraged ETF for TQQQ, and a S&P 500 3 times leveraged ETF for SPXL. The other stuff it's using is TMF, which is a 3x leveraged 20 to 30 year plus Treasury bond ETF, which is TMF, and then QQQ, which is a 1x NASDAQ 100 ETF, SPY, which is S&P 500 1x ETF, VIXY, which I believe is a 1x VIX futures, VIX short-term futures ETF, TMV, which is an inverse of TMF, so a 3x leveraged 20 to 30 year plus Treasury bullish ETF, and then VIXM, which is this is a midterm VIX futures ETF. So those are all the strategy it uses. I'm going to go to the graph real quick because I want to see. So you can see it's pretty blended. It's utilizing pretty much all of the ETFs that are used in the branches above, which is nice to see. So there's a pretty good balance of all of the tickers. So okay, so let me go to the top. So the strategy is called Which Way is Up. It was created by Crazy. And so the first check is 14-day RSI of VIXY is greater than 70. If that's the case, it's basically going to choose between VIXM and VIXY based on the 14-day RSI. Select the bottom one. So it's going to select the weakest 14-day RSI of these two. And I'll go to the charts and actually pull these up. So hold on, let me go back. Sorry. So it's looking at the 14-day RSI of VIXY. Okay. So type in VXY. And it's looking at the 14-day RSI. Go here. So basically what it's doing is looking for spikes in volatility. So if we sort of zoom out, you can see a few periods in time where the volatility spikes above 70, I believe is what the strategy calls for, right? Yeah, above 70. So would have been here back in 2011, here in May of 2012, here in February of 2014, here in October 2014, here in August 2015, here in the beginning of 2018, here at the end of 2018, yeah, end of 2018 again, 2020 for the COVID, obviously. And then other than that, I don't know if there was any other spikes. Doesn't look like it. So basically it's going bullish on volatility, either VIXY or VIXM, when you have these volatility spikes. So those are going to be more short-term plays. It's just going to pick between the two. And then other than that, the bulk of the strategy is probably going to exist somewhere in here. So it's looking at the current price of BND, which is the bond market, if it's greater than its 200-day moving average. And after that, it's looking at the current price of the S&P 500, if it's above its 200-day moving average. And then if those two conditions are met, it's going to go long on volatility for the same, not the same, excuse me. It's looking at the 14-day RSI of S&P 500. If it spikes above 70, it's going to buy volatility. So if that is not occurring, the bulk of the strategy is going to exist here, going long either on SPXL, which is 3x leveraged S&P 500, or TQQQ, which is 3x leveraged NASDAQ. And that is only if S&P 500 is above its 200-day moving average. If it's not, but bonds are above their 200-day moving average, it's going to stay in 1x S&P 500 or QQQ, which is NASDAQ. So just based on the 14-day RSI. If bonds and S&P 500 are both below their 200-day moving average, it's going to go to TMF. Actually, not both, just bonds. If bonds are below their 200-day moving average, it's going to select either TMF or TMV. So it's going to select, what's up? Okay, so it's going to either select TMF or TMV. So either bullish 20 plus year treasuries or bearish 20 plus year treasuries based on a 14-day RSI. So overall, pretty simple. Probably going to be pretty volatile though, especially if it's in the TMF, TMV section. So I want to look and see how it did for 2023. Very good for 2023, 97% return, somewhere in there. 2022 for the bear market also did pretty well. It probably would have been in TMV a lot of in here. 112% return for 2022. 2021 was probably mainly going to be in SPXL and TQQQ, unless the bond market was doing badly, but I don't believe it was. 2020, yeah, so 2020 you'll see this nice spike up during the COVID. Let's see. So about 231% from the start of COVID, which would have been around February 20th, about right here. So it was already up 16%, ticked down just a little bit, and then ticked up using VIXY and VIXM. So pretty good performance there. I'm going to go to 2018 and see how it did with the bond market. So if you look at S&P down here, you can see how it starts to decline pretty rapidly, especially right into the end of the year. This was when the Fed was raising interest rates. So it probably would have been going into or cycling between TMF and TMV here, and then I think the beginning of 2018 was just more of a volatility play. And then I want to see 2015 because 2015 was a flat year for equities, and the strategy does pretty well, and then gets caught in a drawdown at the end of the year, but still outperforms SPY, which is good in terms of being in a flat equities market. And then I do want to look at 2011 as well. So 2011, I believe the United States bond rating was downgraded. I can't remember if it was. Anyway, 2011 was very volatile as well, and it looks like the strategy suffered along with the S&P. S&P was basically flat for the year. But overall, simple strategy, and I think if you took this and sort of ran with it, you for sure could make it better, but I do like how simple it is. So thanks to Crazy for sharing that one. I mean, overall, it still performs, which is nice. You're just gonna have to deal with some volatility. If you look at the standard deviation, 47%, pretty high. So that will tell you a lot about the volatility of the strategy. And it explains here, a measure of volatility or risk of a symphony. The typical amount that a symphony's daily returns vary from the mean of the returns over the time period standardized to a period of a year. So basically 47% could mean it's performing 47% above its mean or 47% below its mean. So there's a lot of vacillation up and down, but you can see that if you, let me zoom it all the way out, or excuse me, not zoom it all the way out, but zoom it all the way back to this period. So you can see it has this huge ups, huge downs, huge ups, huge downs, huge up, huge down, huge run up, huge run down quickly, and then sort of a steady rise back up. So throughout this period up until about 2018, you can see the S&P 500 pretty much outperforms it. And then if I zoom over to the latter years, you can see it vastly outperforms the S&P. So this is one of those things where you would have to have some belief in the strategy and in terms of giving it time to for its edge to materialize. But I do think it's a simple strategy, and you could definitely follow it. So, like I said, it trades on a daily time frame, so there's a lot you can do to it to avoid a lot of the volatility, particularly right here. I think a lot of the volatility is coming from here, TMF and TMV. In fact, let me try something out real quick. Let me save this one. It's just something I was playing with earlier. What's today? 18th. Okay, so because I have a TMV and a TMF that I'm curious to try now. Let me keep the filter, and I'll just run the two strategies inside the filter, see what that does. So 101 and 43, what was the, okay, 71 and 48. Standard deviation was 47. Okay, it brings it down to 43, so it's still pretty volatile, but I think with leverage and all that, you're not really going to avoid a lot of that volatility. So if I drag it backwards, you can see it gets a lot more steady. So I do think this is the importance of, here's where you're going to find the importance of creating maybe some strategies based around a specific ticker. Like these are mostly trend following, so it's going to look for moving averages, mean reversions, and that's pretty much it for TMV, as well as for TMF as well. So it's got a little bit of volatility in there as far as spikes, but they're pretty quick. And it's got some mean reversion here, and then the rest of it is simply momentum or trend following. So these are pretty simple strategies, and it's just selecting. Now, the other thing I could try is an equal weighting of the two. So I'll try that as well. TMF, TMV, and then I'll delete the filter and see how that does. Standard deviation 43, 101, 43, 92, 43. So it stays about the same. So not too bad either way. But yeah, overall, I think it's a pretty cool strategy though. There's a lot of volatility in here. What's this? 2011 to 2015. Actually, no, it's probably more like 2011 through 2013. So very volatile, but also very volatile for S&P. So not the biggest deal. But again, if you're going to run a strategy, I think the big thing you do have to keep in mind is you need to give the strategy time for its edge to materialize. I think that's very important. So, but pretty cool strategy. I like the simplicity of it, and I do like the simplicity of using the 200-day moving average of the bond market as well as using the 200-day moving average of the S&P 500. I think those are important checks because it determines the direction of the trend, and then within the direction of the trend, then you can start using your sort of buy or sell signals. So it's establishing a trend, and then it's establishing what to go long on within that trend. And then outside of that trend, it pivots to other things that could be beneficial in a downtrend for either the S&P or for bonds. So kind of nice. In fact, if I get rid of TMF and just keep TMV, since it's a downward trend for bonds, what does that do? 95, 43, so about the same. I think it's probably beneficial to keep both since they are trend following strategies. They're not always going to be in effect, but yeah, I'm going to keep the filter in there just to keep this spirit of the original strategy in place. But I'm going to save this as is, and then that way I have a copy of it in my personal stuff. But yeah, pretty cool. I do like it. That brought the Sharpe ratio up. It brought the annual return up, and then it also brought down the max drawdown too. So improved the performance pretty much in all categories. It brought down the standard deviation too. So I think that's kind of nice. But again, I do think that speaks to having a strategy for specific tickers like TMF and TMV, because there's definitely times where they come in handy a lot. Especially during things like COVID and then things like 2018, even 2022. If I go to TMF and I look at its performance during COVID, very volatile, but you get very, very quick momentum to the upside. So the start of COVID is here, and if I overlay the S&P, so here's the S&P, this orange line. You can see how it starts to drop quickly. With something like TMF, it's starting to tick up very quickly, and then obviously it comes down very quickly too. So TMF is a nice thing to hedge S&P with, or you can even use TLT. You don't have to use 3x leverage bonds, but just something to keep in mind. So other thing I was going to touch on too, well, I'll just use this strategy for example. So in terms of thinking about building a portfolio, these are some of this was covered in a previous call, but I'll hit on it again just to kind of reiterate and help people maybe keep some things in mind when they're building stuff inside of Composer. What makes a quote unquote good portfolio? The number one thing for me is going to be risk management, and that is position sizing, maybe having a profit target and having a stop loss. Obviously, we don't have profit targets and stop losses inside of Composer. However, you can control that by your position sizing, which walks hand in hand with risk management. So I'm going to give an example. So I know a lot of you guys have already seen this, but for the sake of recording the call and maybe people that are not on the call watching this later, I'm going to go over this again. So if you want to control your risk, you need to figure out how much of your money you want to allocate to specific strategies. So if I want to invest in this strategy, I need to figure out what my risk is going to be for it. So you need to have an overall goal in mind of how much money you want to risk to begin with when you're going to invest in certain strategies. Sort of my end game is I want to be risking basically 1% of my portfolio on any one trade. So using that with Composer can be kind of tricky or confusing because you're thinking about, well, what is a trade? What is one trade inside of Composer? That gets a little tricky, but basically one trade, you would have to go through the strategy and look at when it's allocating to one ticker at a time. So like, for example, that would be one trade right there, right? Because it's moving to SPXL 100% of the time for 1, 2, 3, 4, about 5 days. So that, for example, would be one trade, and then it goes to VIXM. Oops, sorry. It goes to VIXM for 1, 2, 3, about 4 days. So that would be one trade. Goes to VIXY for 1 day. That's one trade. TQQQ for 5 days. That's one trade. So on and so forth. So anyways, the way I figure out how much to allocate to a strategy is I'll save the strategy so that the URL is up to date. I will make it public, copy the public link, and then I'll go over to QuantStats, and I will go to QuantStats, and then I will run it through QuantStats so that I can get the stats on it. So it'll run, and then I'll open up the HTML for it. And then what I'll do is I'll come down here to worst day, and I'll look at its single worst day performance, which is 17.34%. And then what I will do is I'll go over here to calculator.net, and I will go to a percentage calculator. Where am I at? Right here. So you come to this percentage calculator, and then what you need to do is figure out you'll know your portfolio size, but let's say my portfolio is $5,000. I only want to risk 1% on any one trade inside of this Symphony. So what I'll do is I'll take 1% from 5,000, which is going to be $50. And I'll say, okay, my risk for this Symphony is $50. And how do I figure out the risk? Well, I'm going to risk $50 on this Symphony, and this, I'll look at the single worst day performance, which is 17.34%. So I'll go to my calculator, and in this box here, it'll say blank is blank percent of what. So I'm going to put 50 here. So $50 is 17.34% of what? 17.34% is the single worst day performance on that Symphony. And then I'm only risking 1%, which is $50. So putting in those will give me $288. All right, so that'd be $288 out of 5,000. So basically, if you wanted to invest in this, if I wanted to invest in this Symphony, I would allocate $288 to it out of my $5,000 portfolio. If you are building a master, you would do it this way. So you would copy this, the logic from this symphony. You go to, a new block, and then you would save it, change the weighting to specified, and then go back to your calculator. And to figure out the percentage of the master, you would take 288 and you would say, in this box here, 288 is what percent of 5,000? And you would calculate, and that will give you 5.76%. So then you go to your master and you would click to set the weight, and you'd go 5.76% of the master would be allocated to that symphony. And then so on and so forth. You'd keep adding other symphonies to your master until you have a master that you like, and then you can run the stats, blah, 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 blah. So obviously if you ran just this based on its risk, and then everything else was just cash, it would give you an equity curve that looks something like this. Obviously very conservative now, because there's only about 5% of your portfolio allocated to that one symphony, and that'll give you your performance. So 5.3% annually, Sharpe ratio of 2.20, standard deviation of 2.4, max drawdown of 3.1, blah, blah, blah. And so it's a very nice smooth equity curve because you have very little allocated to a very risky strategy. And then the more that you add strategies to this master, the more these numbers will start to tick up. So your Sharpe ratio, this is gonna vary depending on what type of strategies. But your standard deviation is probably going to stay very low, and your max drawdown is probably going to stay very low. So I do think this is the way you can balance out your overall portfolio, and according to what kind of risk you want inside of the portfolio. So that's something that I do with my own portfolio. I do run a master. I have an extremely aggressive one that I run, and then I have a risk weighted one based on 1% risk to the total portfolio. So I kind of have two running simultaneously right now, and it's kind of in the early stages of testing. But this is the way that I build it. Is I'll do it this way. So, but yeah, so that'll help you control your risk. This is how you can manage the risk of your portfolio. This is how you can size your positions or your symphonies according to how much return you want to see versus how much risk you're willing to take. And the benefit of it, obviously, is things like this, where 2022, you see a lot of volatility, a lot of down movement in the S&P, while something like this would sort of steadily rise. So like, if you're somebody that has, I don't know, $10 million, right? You have a $10 million account, this strategy would be extremely attractive because it's very low volatility, but you still have a good return. You're slightly beating inflation, although you're not beating inflation right now under its current conditions, but normal inflation, 2 to 3% per year, you'd be beating inflation with very little risk, almost zero risk really. But so if you had a $10 million account from 2011 to today, you would have doubled the account with almost no risk. So something to think about in the future. Once you start to grow your account really, really large, symphonies like this will start to become very attractive. At least for me, that's kind of my plan for the future. I want to start to see, I would say, if I had an account of probably maybe $3 million or more, I would start to build things that look more like this, or maybe even like a max drawdown of maybe 1%. That's kind of what I'm going to be after, and I'm probably going to be after gains of somewhere 8 to 10% per year, something like that. I don't know, maybe 15 or 20. I guess it depends on the volatility. But anyway, so I just wanted to hit on that. Any questions?
What percentage did you say? Yeah, sorry. What percentage did you say that you would put into that? 7 something?
Oh, into this specific one?
Okay, 5.7.
Yeah, 5.76. Based
Okay, I was just looking at the Kelly criterion, and it's 6.4. So yeah, very close there.
oh, in the quant stats.
Yeah.
That's a good point. That's a good point. I'm glad you brought that up. The Kelly criterion. Where is that at? Up here? Is that
Yeah, right there. Yeah.
okay? So yeah,
There it's. Oh, okay. Yeah, before when I ran it all the way back as far as it went, it says 6.4.
did you run it with the original TMF and
Oh,
TMV?
yes.
Okay.
Yeah. I didn't make any change.
Yeah. So okay, well that would make sense then. These two, yeah. If since these are strategies, obviously they get rid of a lot of the risk, right? And they have a higher return than just buy and hold ones. It will change the Kelly criterion. So the Kelly criterion, as I understand it, it gives you sort of a risk adjusted, what do you call it? Sort of allocation to the strategy. Is that right?
Yeah.
Okay.
Yeah, it's been a little bit since I've looked at the definition and stuff, but
In fact,
that's my understanding.
go
Yeah,
ahead.
basically like to prevent a risk of ruin. And then
Yeah.
sometimes people will double. So like they'll go 2x Kelly.
Makes
So like
sense.
if it's 6%, then they would go to 12.
Gotcha. Yeah, and
I'm sorry, or half. I'm sorry. So if it's 6%, then they would allocate 3%.
gotcha.
They'd go one half Kelly. Yeah.
Perfect. Yeah, that makes sense. And that's a good way to look at it. For example, like if you don't know what your risk is, this would probably be a good place to start. So if somebody is maybe new to Composer or they just came from YOLO options trading on Robinhood, they probably have no idea how much risk. Well, maybe they have a good idea now of how much risk they want to take on strategies. So this would probably be a good place to start because, yeah, this kind of tells you how much of your portfolio you could have allocated to this strategy. And it's accounting for the risk and the returns at the same time. But let me make sure that I'm staying accurate. So here's the definition. So the Kelly criterion is a mathematical formula relating to the long-term growth of capital developed by John Kelly Jr. while working AT&T's Bell, blah, blah, blah. It is used to determine how much to invest in a given asset in order to maximize wealth growth over time. Key takeaways. Although used for investing in other applications, the Kelly criterion formula was originally presented as a system for gambling. The Kelly criterion was formally derived by John Kelly. The formula is used to determine the optimal amount of money to put into a single trade or bet. Several famous investors, including Warren Buffett and Bill Gross, are said to have used the formula for their own investment strategies. Some argue that an individual investor's constraints can affect the formula's usefulness. So, yeah, at the end of the day, this will be up to the individual person and what their risk tolerance is. Like I said, the way I do it is I risk it based on a 1% risk to the portfolio on any given day for that one strategy. So, and the reason I use 1% is because I run a bunch of different strategies at the same time, and they're all based on a 1% risk. So if every single, let's just say I use I run 10 strategies in a master, right? And I've got 10 of these things running and they all hit their worst possible day. I'm going to have a 10% loss on the entire portfolio in a single day, which is a very big loss. But I mean, that is realistic, but it's highly unlikely. I'll put it that way. Because obviously it's based on their single worst day of performance in the entire history of that strategy. So it'd be the equivalent of like having 20 losing trades in a row. Is it realistic? Yes. But is it likely? It's very, very highly unlikely. So anyway, that's how I sort of weight the risk to individual symphonies. Or you could risk 2% in one day, which would double this 5.76. So you would just double like Swiss Caesar was saying, or you slice it in half if you have a larger account and you want to take less risk and you want to risk 0.5 of, 1/2 of 1% to the portfolio, stuff like that. So you could do that, those kinds of things and play with the percentages. But anyway, that's how you would get there. And then, so for the last part of the call, I'm gonna hit on some Mark Douglas, and then I'm gonna sort of wrap it up because today's just gonna be kind of short. So, but I am recording it, so that's good. But anyway, here's another trading psychology, and I think I'm gonna be playing these clips as I do the calls week to week, and I think that'll kind of keep us on track of how to view the markets and how to view our own sort of psychology when we're building these strategies and we're actually running them live. So I'm gonna let this play for a little bit, and then I'll come back in when I'm gonna cut it off. So so here we go. This is Mark Douglas. He wrote the book Trading in the Zone. That's where I got my name from. He's my number one influence as far as trading and investing goes. But anyway, he's more of a trading coach and not so much of a trader per se. Although he does do his own trading. He's passed away now, but more of trading psychology than trading itself.
Hi, everybody. Good morning. Now that John's put the pressure on, that this is supposed to go, bear with me because I haven't done one of these in 3 years.
Oh, sorry.
The last one I did was for John.
I'm gonna mute my mic real quick. I'm sorry, guys. There we go.
And April in Chicago in 2012. So it might take me a while to be going. So hopefully it'll be done. But anyway, I think the way I want to start out is by answering a question that a lot of you guys, not a lot, a few people I've talked to yesterday and a few people I talked to last night were asking me that I'm writing a third book. And I guess I should ask you first, so have a lot of you read Trading in the Zone or Disciplined Trader? And so you're probably wondering, well, why am I writing a third book, right? Would that something become your life? Yeah. Okay, well, why am I doing that? Well, okay, here's the reason why I'm doing it. About 8 years ago, I was asked to speak at a trading conference that was going to be quite large. Be about 5,000 or 6,000 people were expected to attend the conference. It was going to be in Texas. And, a few people have been in this business for a while. You'll know that there's a lot of people that just aren't at it. I mean, there's a lot of ways that people can be taken advantage of in this business, and there's a lot of people that understand that, and a lot of people that exploit people who want to become traders. And so as a result, I didn't want to be associated with somebody or an organization that fell into that category. And I asked them to, and I knew they had user groups all over the country, and so I asked them if I could attend some of their user group meetings to see just how well they lived up to their claims of customer service and the kind of products that they offered. And so they had a pretty substantial user group in the Phoenix area. And I attended. There were probably a little over 100 people, maybe 110, 20 people. And I was just kind of taken back. One, I mean, everyone was really enthused with this company. They really loved the product. They loved the customer service that they were providing. And but the other thing I was taken back by was just how absolutely, totally clueless they were. And because I was used to working, I started coaching in really around 1982 or 1983. And most of the people that I worked with were like floor traders, the Chicago Board of Trade, Chicago Broker-Dealer Exchange, and then later on a lot of hedge fund managers. And, people who fell in the category of what I call professional traders. I mean, people who are diehard traders. And so actually my coaching clientele kind of fell into two categories with nobody in between. In that I had the professionals, people who've been in the business for a long time, and they understood just based on their experience, the importance of their state of mind and their psychology played on their results. So there wasn't any convincing them, that this is the direction they needed to go. And then at the other end of the extreme was the person who had been in the business for probably quite a while, lost usually a lot of money, lost their account several times, and they're at the point of what I call total and complete exasperation, where you might want to think of someone being on an alcoholic bender, and they wake up with their head in the gutter, literally the head in the gutter, and they look up and they say, "Okay, God, I'm ready. I'll do anything," and they mean it. It's not lip service. It's not bullshit. They really mean it. I'll do anything. And so I didn't have anybody in between, because they didn't realize what they were getting into. Okay, so basically, this group of people in the user group, they were all these in-betweeners, and not only were they just in-betweeners, none of them were professionals. They were like, just really what I call nice people. But not that professional traders can't be nice people, but they're agreed upon. They really are. They're I'm not going to get into that, but in any case, they're different. But so I'm thinking, you know what? I have to write a book for these people. I just, because the disciplined trader and trading in the zone did not really address the issues in a way that someone just starting out in the business could relate to. I made a lot of assumptions writing those books. I made a lot of assumptions based on my experiences of doing these kind of presentations and speaking at trading conferences back in the, in the early 80s. Like the first conference I spoke at was in 1984. And I spoke at, several years later. Even went on a world tour for Dow Jones in 1987. I literally went around the world for Dow Jones and Reuters. Out of a 36 city tour, I could have done all 36 cities. I didn't want to be gone that long, but I did 18 out of 36 cities and went all the way around the world. So, it's like I have this base of experience of the way people think about trading, but yet, like I said, I didn't write these books in a way that the novice trader could relate to. And it shocked me. It literally shocked me because The Disciplined Trader was published in 1990 and Trading in the Zone was published in 2000. And when the internet started getting big, and you had a lot of people doing chat rooms and all this sort of stuff, and people were recommending, that hey, read Trading in the Zone, and a lot of the people that were reading it were just novice traders, because I'm getting this feedback and emails. It's like, whoa, this book wasn't meant for you, and I didn't even really know how you were relating to it. So I thought, you know what? I got to write another book. I got to write it from the perspective, and I got to write it from the perspective of someone who really doesn't know anything about this business. The people in that room in Phoenix were people who basically have watched like a half-an-hour infomercial on how you can take financial control of your life by being a trader. Okay, secure your retirement. Go into trading. Okay, with this particular methodology, you should be able to do it. Well, the reality of it is, a lot of these methodologies, people aren't lying to you about the fact that if you can actually follow the methodology, you can secure your financial future. The whole idea is being able to do it. It's like, for example, the very first workshop that I ever attended was in Bermuda, like I think in 1981, and at the time it was being put on by at that time, people who were considered market gurus. And, and at the very first morning of the conference, I mean, I'm really excited. What am I going to learn? Oh, I just can't wait. And I sit down in the room, and the speaker, he gets going, and he's going for about 10 minutes. And someone in the audience raises their hand, and he stood up. And Jake, the speaker's name was Jake, and he stood up. As a matter of fact, it was Jim Bernstein. He's written a lot of books. You probably heard of him. Anyway, so Jake acknowledged the guy in the audience, and the guy stood up and he said, and the speakers, of course, were going to talk about their trading systems and how people use them, that sort of thing. And the guy stood up and in kind of an indignant tone that really surprised me. And I think it also surprised Jake. He said, Jake, your system's so good, why are you selling it? And, I think the whole thing kind of took Jake by surprise, like I said. And Jake just stood there and thought for a second. He said, you know what? I'll sell as many of them as you want to buy. Because out of all the hundreds of people in this room, there probably isn't one of you that could go back and execute it. Now, I'm sitting there listening to this, and he didn't say this in a way that I thought he was kidding. So I'm thinking, well, what's going on here? And nobody asked him to elaborate. So it's like, I'm just hoping this didn't apply to me. Okay, I'm just like, I don't know what he's saying. I don't know why he's saying it. I just hope it isn't me he's talking about. Okay, and it was, of course, it was, it was definitely me. That's probably as well as everyone else in the room. So anyway, like I said, I really felt I had to write something from ground zero. In other words, if you don't know anything about this business, if you don't know anything about the nature of trading, and especially if you don't know anything about the nature of price movement, that you can actually go through, understand what you need to go through, and go through a process of changing the way that you think, because this is what this is all about, everybody. You're going to have to get used to the idea that if you're going to do this successfully, you are probably going to have to change some major assumptions, some major beliefs you have about the need for market trading to do successfully. I'm not saying you're not going to have winning trades. I'm saying that if you want to create a consistently rising equity curve and assure yourself of an income, you're going to have to think differently than what you think right now. There's no way around it. Like, for example, most of you in this room, just quick example, most of you in this room would think that because I'm a trader, and because I put on trades, I'm a risk taker. Does that make sense? Because we know that trading is risky, right? Come on, I'm going to have to get some feedback, guys. Okay, you can't sit there stone-faced. So you really can't. Seriously, I mean, you can, but it's going to make things hard for me. I don't want to be hard. I want to enjoy myself. Okay? So come on, just give me some feedback. Yes or no? Okay, thank you. Remember, I haven't done this in 3 years, so give me a break. I'm asking you nice. So, yeah, we're risk takers, right? And yet, when you think about it, everything that you do, or let's say I used to do as a trader, with respect to analysis, was to try to eliminate the risk, was to try to make the risk go away, was to try to make sure that the trade I'm getting into right now, this trade, was going to be a winner. Not maybe a winner, but going to be a winner. Or why would I do it? Why would I get into a trade if I didn't think it was going to win? Does that make sense to everybody? Is that the kind of logic that makes sense? That's exactly the kind of logic that's going to make sure you're not going to be successful in this business. It's exactly the kind of logic that is going to assure you that you will not make it in this business. This business has nothing to do with winning on a trade-by-trade basis. On a trade-by-trade basis. What you're going to learn today is that your technical systems, okay, what they give you is an edge. Everyone, you heard the word probability said 100 times. Probabilities, edges. Edge is nothing more than a higher probability of one thing happening over another. There's a huge difference between understanding that concept and actually believing it in a way that you can execute your trade properly. You actually have to believe in the nature of probabilities at the very core of your trading personality. Which means you're going to have to give up on the idea that each individual trade is going to be successful. What your system does is give you an edge over a series of trades, where the outcome of each individual trade is unknown and unknowable. Not just unknown, unknowable. The more you think you got to know in this business, the less successful you're going to be. This isn't a business about knowing what's going to happen next. It's a business of getting your mind to the point where you're completely detached from your outcomes. Very different than the way we live our lives. Gino, we were talking to Gino last night. Gino's been an attorney for how many years? 43 years. What did you learn when you became a trader in relationship to the kind of strategies that you used as a trader? Did you hear what he said? Everything you use to be a successful lawyer is completely opposite of the strategies and thinking methodologies that we have to use to be traders. If I'm a lawyer, am I detached from my outcome? If you are? Yeah. If I'm a lawyer, am I detached from my outcome? Oh, no. If I'm a lawyer, am I detached from my outcome? Absolutely not. I'm going to make sure that I get the outcome I want. If I'm a doctor, am I detached from my outcome? If I'm an engineer, am I detached from my outcome? So if I'm saying to you, to be successful in this business, you're going to have to become detached from your outcomes. Just how in the world are you going to get to the point where you can do that? You don't know. You're right. You probably don't. Thank you. Trade for somebody else. Not everybody, the group's falling. The people that can trade for somebody else and be detached and trade for somebody else, and actually they're even more attached than what they would be normally. I've worked with both ways. There are people who can actually trade their own money. Once they learn the right methodology, the right mindset, they can trade their own money much easier than they can trade somebody else's. Because they're more concerned about, losing money for other people. If somebody you don't know, okay, it's still, there's a lot of variables in there. Yeah, that's, So basically, I had to write this book from, like I said, from the perspective of going from the ground up. And having 2 books under my belt, which I thought were really tough books to write. I mean, they were very, very difficult books for me to write. And I'm thinking, and here, this is my own bias that I'm going into this whole project with. Like, okay, I built the business trader, took me 8 years. I was trading in the zone, took me 5 years. Come on, I should be able to knock this out in a couple of years, right? Anybody, right? Should be able to knock this out in a couple of years? 8 years, I'm still not done. Way harder than trading in the zone. Way over the top harder than trading in the zone or the business trader. I can't even begin to tell you how difficult it's been, and how challenging it's been, right? And how the impact that it's had on my life. It's really been very, very difficult. But in any case, I found that breaking these concepts down to a core level where someone who doesn't know the business can understand it is not easy. And I made a lot over the years. Doing presentations, I've made a lot of assumptions. See, it's one thing to know how to trade, to break through a certain what I call the threshold of consistency. Like if over here, this is like a mental threshold, okay? Like if you're down here and you're booming and busting, okay, your equity is, you go up, you go down, you go up, you go down, and you want an equity curve that looks like this, you're going to have to break through what I call the threshold of consistency. And this is a mindset. It has nothing to do with their methodology. I say nothing. But you're going to have a good edge. All I'm saying is that, but there are a lot of good edges out there. Okay. But so this is a mindset. Yeah, but breaking these concepts down in that way was just, I made a lot of assumptions, and breaking through my own assumptions was really a difficult process. Because what I was getting at is that it's one thing to learn how to trade for yourself, and however way you manage to break through the threshold of consistency, it's another to actually learn how to teach people how to do it. The process of doing it and teaching people how to do it are worlds apart. There's almost no connection. There's almost no connection at all. Because there are a lot of people who teach trading because they become successful traders, legitimately successful traders, and they teach it from their perspective without realizing that their audience is nowhere near their mindset and cannot do what they do. When I was, coaching in the early, the mid 80s to early 90s, I'm not going to mention names, but there were some, trading gurus out there that had huge followings and, brilliant people, very successful traders, but absolutely did not know how to teach it, did not know how to understand, where the common guy was coming from. And most of like really serious suicidal clients were as a result of listening to these people, the ones that ended up, waking up in the gutter saying, oh my God, I'll do anything. Just because they don't know how to teach it, that's all. And because the process of learning how to teach it is just completely different than the process of learning how to do it. So like I said, I made assumptions. And those assumptions resulted in, making it really difficult for people reading The Disciplined Trader and Trading the Zone to get what they needed out of it to break through this threshold of consistency. And I didn't really know that until, I got almost to the end of the book where, it is like the exercise and Trading in the Zone. When I finished that book in like 1999, it's like I thought I explained it. I really did. I thought I explained it. I'm going to apologize to you now, realizing that I didn't. I really didn't explain it because in this new book, I've devoted 30 single-space typewritten pages to just the exercise. Because the big assumption that I made was that all the background, all the material that I wrote to as foundation to do the exercise, that somehow people would find a way to assimilate it and realize the connection on their own. And then when I started actually getting to the point where I had to write about the exercise, I realized that wasn't going to happen. And the reason why I know it didn't happen is because I would do presentations and, like for example, in 2008, 2009, 2010, whatever, and like because I did several for John in a row, like where I did, like I said, 8, 9, 10, 11, and 12. Last one I was in 2012. And so like in 2010, I go through the whole presentation, and explain what I felt people needed to get, and the exercise itself. But pretty much explained it within the context of Trading in the Zone. And then the next year, some people would, a lot of the same people, there's 100 people in the room, but there's a small percentage of them that were there the year before. And I was like, how many of you did the exercise? Nobody. And not only that, I was wondering, okay, everyone in the audience pretty much, let's say the large percentage of people in the audience had read Trading in the Zone. And right off the bat, I'd say, okay, you've read Trading in the Zone. A lot of people said they've read it multiple times. So I'm thinking, how many did the exercise? Nobody. And it's like, so in 2011, we were going through this mystified me. Now, I was truly perplexed. I really was. I did not get it. I really didn't get it. And so in 2011, somebody in the audience just happened to say, after we're closing, getting to the point where the presentation is completed, there was what times I had. And someone said, well, how many of us do you think are going to do the exercise? And I said, nobody. They're all taken back by that. Because I was just flat out, none of them are going to do it. And then the next year in 2012, there were a few people that actually did it, and they got the results that they were looking for. Now we're going to talk about this. We're going to talk about it in great length, mostly tomorrow. But it's like, I want you to leave understanding the process, understanding what it is that you have to do, and the process that you're going to have to go through to get to the point where you can acquire the kind of psychological skills, because all the skills, there isn't anything about trading that's physical. What are you interacting with? You're interacting with information. There isn't anything physical other than just, if you got the ability to use your mouse pad or use a mouse, you got the eye-hand coordination to put your mouse on a certain spot on your trading platform, you got the skills down pat. You're golden on the skills, the physical skills. It's mental skills. It's how we interact with information, the state of mind that we're in. people don't realize that, that this is like to really do trading at a really high level, what I call the subjective or the discretionary mode, as opposed to mechanical trading where you've got a particular set of criteria that define your entry and exit, and it's rigid. So the market has to conform. Market has to conform to your rules, or you do nothing. Okay, I'm just going to give you a cursory explanation. In the mechanical mode, the market has to conform to your entry and exit rules, or you do nothing. There's nothing to do. There's nothing to think about. You're just supposed to do, enter what it says, put your stop where it says, put your objective where it says, and it either happens or it doesn't. Okay? In the subjective mode, basically discretionary mode, you can do whatever you want, whenever you want, based on whatever information you expose yourself to, and the way you want to combine that information in your brain to come up with an entry or exit signal, and where to put your stop and where to put your profit objective. To be in that mode and do it successfully, you better be in a real elevated state of mind. Because what you're going to find is that it's your attitude, it's a quality of your state of mind. Like, are you confident? Are you fearful? Are you in a carefree state of mind? Are you agitated? Are you angry? You feel like getting revenge? If you're going through personal emotional trauma, if someone said, if someone you knew was trading, was a full-time trader, and they're going through a real traumatic experience in their life, would you advise them not to trade? Makes sense, right? Just makes sense. And yet what people don't realize is that there are degrees of states of mind. And
Okay, I'm gonna have to stop it right there, guys, because I gotta get going. But I'll pick up on that next week. I'll make note of the time where the video's at, and I want to try to get through this series because I think it's really important. I think it does really help with the Symphony building side of things and the day-to-day trading activity. So, anybody else have anything? Any questions or comments or anything they want to add before I sign off here? All right, cool. Well, I'll leave you guys with that, and then I'll try to get the video of or the recording of the call uploaded as soon as I can. So, thanks everybody for joining. I know it was not a ton of people here today, but at least we got it recorded. So, all right, everybody have a good rest of your weekend. I'll see you guys next week.
Thanks, Garrett.
Yeah, you got it. Thanks, man.